attendees are in listen-only mode.
Good morning and welcome to today's Premium Account Short Form Market Update. Any individual reading or listening should discuss with their financial planner or advisor the merits of any recommendation offer presented in this material for their own specific circumstances and realise that not all investments are appropriate for every individual. Presented today, myself, Leon Hine, current Managing Director of Global Equity Management. The format for today's presentation, it is a short form webinar, so we just do a quick summary of the global macro outlook. We review a select few stocks of the ASX Top 50, in particular focusing on Rio, BHP and Woodside Petroleum. As we come into the third quarter production reports, we look at the companies that are hosting their AGM in the week or so ahead, and we summarise the stocks that we've been active in, either from the standpoint of buying or acquiring for portfolios, or looking to set derivative strategies over existing positions that we've got, and we conclude with a short-term market outlook and a general summary of portfolio allocations. The services that we provide are up on the screen there, and if you'd like to know more about those, please contact either myself or Christine on info@investorsignals.com. Moving straight into a graph of the XJO. Now, our base case from a global macro standpoint is we see that the issues in the US to do with the budget negotiations and ultimately the debt ceiling negotiations, we do think that an agreement will be met there, and we don't see it providing any sort of structural change to our view that central bank policy will continue to remain supportive for equity valuations. Low global bond yields will continue to drive money into equities. We're of the view that markets are reasonably expensive at the moment, and it's not until we get into probably the early to mid part of next year that we'll start to see some re-acceleration in global GDP, which should lead to growing revenues and growing profits to help continue to expand the equity market recovery. So across the next number of months for the XJO, we're probably inclined to see that the market moves sideways, albeit at this sort of elevated level, and then as we get into the early part of the new year that we start to see a rally. We've always been of the view that the resource stocks probably are an area of the market where analysts have underestimated the growth pickup, and we're starting to see the early signs of that reflected in the share price performance of some of these resource names. From a yield standpoint, the market's trading at around a 4.5% dividend yield, trading almost 15 times forward earnings. So I think at best you would argue that it's fair value on the basis that bond yields are so low at the moment, but there's certainly some good names there within the top 50 stocks that are worth owning, especially if you complement it with a covered call strategy. The first stock we look at in today's recording is Rio. So just announced its third quarter production report, came in at 64 million tonnes. It was essentially in line with forecasts. The positive is that it's suggesting that the 290 million tonne per annum ramp up continues to go according to plan. The exploration spend was down almost 730 million for the 9 months, so that looks like it's tracking ahead of the company's budgeted 750 million reduction. So combination of stronger iron ore prices, expanding production, good cost control, I think is the theme for both BHP and Rio over the next few years, and we'd expect to see, we have a target on Rio to see the stock back up between $65 and $70. From a valuation standpoint, Rio trades roughly around 10 times forward earnings on a 3.5% dividend yield, looking for earnings growth somewhere in the order of 10% plus between 13 and 14. Also of note coming up is Woodside Petroleum's production report, which comes out on the 17th. Given that we haven't seen any comments out of the company about maintenance outages with Pluto, I'd expect to see the third quarter production pretty strong for Woodside Petroleum. So we own it at lower levels. We bought into it on this recent sell-off. Up at around $39, we start to look at the opportunity to sell the covered calls up at around $40 or $40.50 towards the end of this year. I think sort of that puts Woodside back on a yield of around 5.5%. If we were to see the stock rally up to that $40 range, I think it starts to run into resistance there, probably consolidates, but certainly over the next 2 to 3 years, I think Woodside could consistently trade sort of within that 40 to 40 sort of $3 price range. Also, let's just, on the resource front, cover off on BHP quickly. So we're looking here for BHP to trade up to our target, back up to around $38. We've given ourselves a bit of time there with a view that probably that's something that we start to see in that December to January period. In saying that, we own it at lower levels down here. As the stock moves up to around $36.50, we'd take the opportunity to reset those calls up at around $38, and that'll lock in some nice gains there. A combination of the sort of 3.5% dividend plus the call premium, we're driving about 10% cash flow out of BHP. From an earnings standpoint, the stock trades about 12 times forward earnings, and we're looking for where the market did have earning forecast at around 10%. We've always been of the view that we could see that accelerate up to around 15%, and that supports our higher valuation for BHP. With the banks coming into their ex-dividend period in November, within the banking sector, we like ANZ and we like Westpac, so we've been buyers of ANZ just on this recent sell-off. We're selling the 32.50 calls over ANZ European style, so we collect the upcoming dividend and looking to get around 50 to 60 cents for those calls into that January period over ANZ. From an earnings standpoint with ANZ, I think, probably with all the banks, we're looking for around about 3% earnings growth. ANZ trades about 12 times earnings on a 5.5% dividend. The other banking stock that we've been recent acquirers of is WBC. And from a valuation standpoint, Westpac sits on similar metrics there, around 5.5% dividend yield, trading about 13.5, 14 times earnings. Probably likely to grow earnings somewhere in the order of that 3%. Some of the recent loan growth data for residential mortgages was a little bit below analysts' expectations, but we don't read too much into that. I think sort of generally there's a pickup taking place within the housing sector, which should remain supportive for loan growth, and ultimately leading to a pickup with the lower interest rates and the RBA's strategy to stimulate the economy. We should ultimately start to see a pickup in business lending as well. I think given the strong focus on cost control within the banking stocks, somewhere between 3 to 5% earnings growth I think is achievable. Our strategy here on Westpac is to own it at or near these levels, and again go out, sell the covered calls European style into the early part of the new year, collect the upcoming dividend in the November period, and boost that dividend yield from sort of around that 5.5% up to in excess of 10% through that covered call strategy. The other names we're just taking advantage of whilst they've pulled back a little bit at the moment is ASX. So we've been accumulating this again roughly on a 5.5% dividend yield, about 15, 16 times forward earnings. We've been buyers of it here. We're waiting for the stock to rally up to around this $35.50 level, and then we'll look to sell calls up at around the $37. I think that caps any upside recovery. ASX, I think, really, albeit that there's not a lot of earnings growth, we think it's it's a very defensive profit line, and certainly has the prospect of some corporate takeover activity re-emerging over the next 12 to 24 months, which will continue to support the share price. So we're buyers of ASX at or near these levels, riding the covered calls, increasing that cash flow up to 10% through the covered calls at around that $37 level. Also on the pullback, we've been recent buyers of Woolworths. So that Woolworths and Wesfarmers are certainly expensive from a PE standpoint, but with Woolworths trading at around a 4.5% yield on forward earnings, should grow earnings around 5 to 6%. I think down here at around 33.50 is a good buying opportunity. Certainly up at around 35.50 is getting expensive. Our strategy is to own it here, wait for a small recovery, and then look to sell the covered calls up at around this 36.50 level. Again, boosting that dividend yield from sort of 4.5% up to in excess of 10% and allowing for some capital growth there. In the stocks that we had been owners of over the past couple of months, and we've been waiting to sell the covered calls, Stockland's finally reached our price target here, where we've been able to sell the 4.25 calls into March. So we've got an upcoming dividend of around 12 cents. We picked up 8 cents for the 4.25 calls, gives us around 20 cents of income on a 6-month basis, so around 40 cents on an annualized basis, which equates to roughly 10% cash flow that we're generating out of Stocklands. So we're either happy for the stock to bounce sideways and continue to reset the call and collect the dividend, or if at the end of March the stock's trading 4.25, that'll provide a significant capital return as well as the cash flow that we generated, given that we own the stock from back here at much lower price levels. From an earnings standpoint, Stockland should grow earnings somewhere around 5 to 7%, and the stock trades around a 6% dividend yield. Amcor's another name that we've been active in. We haven't managed to get the calls away here at the moment, so we've been buyers of it on this sell-off. We're looking for the stock to get back up to around 10.60, and we'll look to sell the calls up at around 11.25. The issue here for Amcor is some of its global peers have reported their earnings results are a little bit softer than expected. Analysts or investors are a little bit concerned that Amcor's emerging market exposure may not deliver the growth that they were originally expecting. On current standing, the emerging markets represent about 22% of the business. Post the demerger of the Australasian packaging business, that emerging market will represent around 30%. Management of Amcor is looking for the demerged entity to have a lower growth rate, but certainly the core business here with its emerging market exposure, the expectation is for it to deliver 10% minimum EPS growth over the years ahead. So at a roughly a 4.5% dividend yield, the stock's expensive at these levels. As I've chatted about, stripping out the Australian packaging business will unlock some value for shareholders. We're still comfortable being owners of Amcor. I think, once a little bit of this negative news is out of the way as a result of its global peers reporting, I think we will see Amcor back up at around 10.75, and we will get a chance to sell those 11.25 calls, again driving that dividend or that cash flow from around 4.5% up to 10% and giving the opportunity for some capital gain there on the upside as well. Computershare starting to play out. We were owners of this at lower levels here. We've predominantly sold the covered calls anywhere from 10.25 up to sort of this 10.75 level. So we have an effective exit price of between $10.50 and $11 over the next, starting in the October option expiry and running through to some positions in November and into December. I think Computershare will deliver sort of 10% EPS growth. Some of these names that we're continuing to favour are off the back of an eventual recovery in the US dollar post the budget and debt ceiling negotiations passing. I think we'll see a recovery in the US dollar, and the likes of Computershare, Brambles, Westfield, CSL all should be at the margin beneficiaries of that. The other name that we've been patient with has been Transurban. Again, we own it at lower levels here. We've been looking for the stock to rally up into this into the low $7 range, with a view that we're trying to sell the 7.25 calls out into the early part of the new year. We will collect the upcoming dividend in December here, so I think from a return standpoint, if we do deliver the stock under the call, it'll provide a fairly substantial return on capital gain, given that we own the stock at lower levels. Otherwise, even if the stock does just continue to bounce sideways, we drive that annualized cash flow from around 5% up to in excess of 10% there on Transurban. And just to conclude with a quick look at the AGM season, so we've got Fox, which reports, and I'll just bring up a couple of these codes as we have a look at them and share our view on the pricing. So Fox reports has their AGM on the 18th of October. We like this name. We've been buyers of it at around $34.50. I think the stock's worth about $37.50 in the months ahead. The company should deliver 10% earnings growth. They've got a $4 billion share buyback underway. The stock should be well supported here. This is a name that should do well post the US budget and debt ceiling negotiations passing. So keep an eye on Fox. BXB, we spent a bit of time chatting. They got their AGM on the 22nd of October. We got the upcoming spin-off of the recall asset. We'd expect to see comments out of the company around the timing for that, but we continue to like Brambles, both from a 5 to 8% earnings growth perspective and the unlocking of some value for shareholders through the spin-off of recall, and it's a little bit of a play on global GDP recovery in the next 12 to 24 months. AGK have their AGM on the 23rd of October. We like this name. We just think it's getting a little bit expensive, about 8% earnings growth, looking for it to consolidate up at these levels up at around $15.50 to $16. And also Origin has their AGM on the 23rd of October at 19-20 times earnings. The stock's looking a little bit expensive for us at around a 3.5% dividend yield. We think it's getting close to full value short term. If we go out 2 to 3 years, arguably it's got the best earnings growth potential within the oil and gas space. We could see Origin profit increasing by as much as 50% into 2017, 2018. So, if we were to go out 2 to 3 years, we could certainly see Origin trading back above $20 a share again. So they're the main AGMs coming up. We've also got Toll and Stockland coming up towards the end of this month as well. And just to conclude with the quick look at the XJO again and just recap our view. So we think the market's well supported here. We'd expect it to consolidate for another month or two. We are looking for the impasse to be resolved in the US, and whilst there might be some short-term relief rally around that, we think given that the markets are reasonably expensive, we're probably more of the view that we get a consolidation and then we start to see some more optimistic outlook towards global GDP, which should feed into stronger revenue and earnings growth for global equity markets over the course of 2014. Also, just to keep in mind that the S&P 500 report the bulk, around 70% of the S&P 500 report their earnings over the next 2 weeks. So we'll keep an eye on that and recap that in next week's recording. Thank you for listening in. I look forward to speaking again next week.